Hi guys, I'm back again with another video. So on today's video, I'll be showing you like the chart patterns that I usually pay attention to, or any patterns that anybody that is participating in the markets tend to find and look out for because they are repeated themselves. So before we get into the charts, I will start here and then go into the charts to actually show you there what's going on. So what are chart patterns? They are formations that are formed by the price movement. So in a nutshell, they are a combination of all the previously mentioned tools of technical analysis, the support and resistance, trend lines, and candlesticks. So what I understand about the market is that whatever that you see in the charts, the patterns, there is no pattern before there is a candlestick. So anything that is there is made up of the candlesticks, except for things like support and resistance and other tools. But whatever that has got candlesticks in them, whether it's a pattern, whether it's an uptrending market, but the whole point that I'm trying to make here, all that is a result of certain formation of candlesticks, right? So patterns, so the price action or technical analysis, like I think it's a common thing that everybody has heard, that the price repeats itself. So we just use the past price to understand the market and also go to the current price to understand what is possibly to happen. Right? So patterns always repeat themselves, hence it is easy to identify them. Traders use chart patterns to find the trend movements of a security traded and literally form in any time frame. So yeah, like I said, that we use chart patterns as a way to find entries or to understand the market. Right. So and also they form in any time frame, so you can find them in time frames. But it's important to note that there are different type of patterns, and also they mean different things and also behave differently, right? So we need to understand behind. So it's not like I always said in the previous videos, that it's not about the candlestick, but it's about how you understand and use the candlestick. It's not about the time frame, but it's about how you understand and use the time frame. So I will say the same when it comes to patterns. It's not about the pattern, but it's about the psychology behind it. What does it represent? What does it mean? How do you use it to work in your advantage? Right. So like I said, that the different types of patterns. So this type of patterns comprise or consist of continuation patterns and reversal patterns. So continuation patterns are based off the fact that the market is going to continue from the direction it came from initially. Reversal patterns, which is you have a downtrending market, and then at the end of that downtrending market, there are patterns that will serve as a signal that the market is about to change direction. So continuation patterns, like I said, are based on the premise that the price of a certain currency stock is going to continue moving in the same direction even if the pattern completes, right? So popular continuation patterns include your bullish or bearish channels, some people call it flags, falling and rising wedge, ascending and descending triangle, expansion channel, expanding, bullish and bearish rectangles, right? And then you also have another type, reversal patterns, which is a chart patterns that show it. So reversals, they actually represent a change in price movement and direction, right? So yeah, I'm not gonna dwell deeper into this. I will make time for a video that I will focus solely on the reversal patterns, but for today I'm going to focus strictly on continuation patterns. So let's get into the charts for me to actually show you that. Okay, sharp. This is the analysis that I made from the market breakdown video, so just do check it out because it played out as I had anticipated it. But I'm not gonna focus on this. I'm gonna try and find another NAS 100 that is clean, so that we can have something that's clean and clear, right? So I'm going to start off with the flags or channels, right? So you would remember, guys, that we have after every impulse move we get a correction. So all these patterns, sometimes it's just corrections, but they were given names. It's like everything that you see in the world. Some things were not created and given names as they are, but because we have to use words to understand what is what. So that's how it is here. So remember, in the market, we have, after every impulse move, we get a correction, regardless of direction. Impulse move, correction, right? So we have bearish continuation flags or channels, which is the one that I'm going to show you. Like I said, that continuation are based off the fact that if the market was trending to the downside, it's going to correct, but at the end, it's going to continue from the direction that it came from. So that is why I'm going to start with bearish continuation channels or flags, which is one of the most candles that I pay attention to, that I see it playing out almost every time. So it's something that looks like this, a bearish continuation channel, but I'm going to highlight them now and also make you see and understand how do they behave. So if you look nicely on this chart, you would see that this is a pure example of this chart pattern that I'm talking about. So the best way, because it's like I said, it's not the point in understanding what is a pattern, but it's how you use the pattern. So if the market, it's also, you don't pay attention to a chart pattern in its own self, but you also have to, what is important is you understanding the direction of the market, because then the pattern is going to perpetuate the analogy or the direction of the overall market. So that's how patterns form. So if you look at this, you would see that we had an impulse move and then this is a correction. So this type of pattern, this is what is called a bearish continuation flag, because the market was impulsing to the downside and then it gave us a correction and then continuation to the downside. So this is what it means. And you combine, because you use this pattern, or you understand them interchangeably with the reversal patterns, because without a reversal pattern, it wouldn't be easy for us to understand how to use these continuation patterns. So for example, if you look at closely here, we also have some sort of a head and shoulder, which is a reversal pattern being found in a continuation pattern. So that's why I'm saying we use them interchangeably. We can even add another technical element here, that this was a resistance. So you see that impulse move correction goes back to what I usually say, that you must look at how the market is approaching a certain level. Then it approaches this in a corrected manner. And then after the continuation, then that is what is called a bearish continuation flag. So continuation flags are flags that look like this, right? So in terms of trading them, you can either take a risk entry in such manners, because as you can see, this is a head and shoulder. This was an emerging head and shoulder before it actually happened. But if you ignored, maybe didn't say this one, you also notice that we also have a double top type formation. So it could have made sense if you would entered on the breakout of this pattern or trend line, or some would prefer to wait for the retest and then continue to the downside. So we can see plenty of them here playing out, because the market repeats itself. Impulse move correction, impulse move correction, continuation, impulse move correction, continuation, impulse move correction, and we had a continuation to the downside, which is what I think could possibly happen again here. Because if you look clearly here, we would consider, if we consider this as a correction or a triangle, then what I'm waiting for from NAS 100 is to come back here for a retest and give us the continuations to the downside. So this is an example of a bearish continuation channel or flag. You can either enter on the emerging reversal patterns inside the pattern, or you can either wait for that head and shoulder that I showed you here, or when a head and shoulder reversal patterns forms outside of the structure. So this is a pattern that is called the bearish continuation flag. You just need to understand these dynamics, or these things that I just explained, for you to be able to take advantage of them. Right. So let's go to another side of it all now. So when we do not have a bearish continuation pattern, then we have a bullish continuation pattern. Right. So bullish means we are buying or we're going to the upside. So a bullish continuation flag would be something that looks like this. So if we can come and identify in the market, you will also notice that this is a beautiful continuation pattern. This is a beautiful continuation pattern. Then we also have a second one over here. And then we also had a third one possibly here. Right. So this, and then this was just the market. Fuck, sorry about that. So it's not a clear one, and I wouldn't consider as one because this is a resemblance of a consolidating market. So we're going to ignore that part. But if you look clearly here, you would also recall what I just said, that in as much as we are focusing on continuation channels or flags, but you also find that the reversal patterns are also found inside these structures because we use them interchangeably, right? So there is no continuation pattern without the reversal. There's no reversal pattern without a continuation flag, right? So if you notice here, this was an impulse move, then this was a correction, and then we had a continuation to the upside. And then we also had this impulse move, and then the smaller version of a correction, and then we went to the upside. Market started consolidating, and it formed yet again. So do you realize that what I said to you, it's the direction that matters, because the market now is just continuing with this direction that it came from. So these patterns are just perpetuating or continuing with the fact that we're still going to the upside. And then it makes a lot of sense now when you combine with things like this, because they serve as a representation that we're still going to the upside. And then that is where you must take advantage of them. So now the question is, how do we trade this type of pattern, right? So as like I shown you on the other one, you can either trade these patterns from the breakout, which is the break of the trend line, or at the reversal point initially, right? So what I'm talking about, you would notice here that we also have an inverse head and shoulder type of pattern. So this could have been enough for you to say, I'm going to start looking for buying opportunities at that support, because impulse move, then with this correction. And if you pay attention to candlesticks are important, guys. There is no pattern without a candlestick. Because if you look at this impulse move correction, and then the market finally broke this trend line impulsively. So the best breakouts are one where the market breaks a structure impulsively. That serves as a direction that the market is going to go into that intended direction. So if you want to trade this type of pattern, then it's best if you wait for this type of thing, which is if it forms, for example, a support level like this. You must pay attention to candlesticks, but these are considered risk entries, because as long as we are still inside the structure, we are still looking for sells, unless of course if it breaks out like it did here and printed a nice candlestick like this, which is a bullish continuation, which is a bullish engulfing candle, to actually tell you that the momentum is still with the buyers and you're still going to the upside. So that is how you would trade this type of pattern. Trade it on the breakout and then retest sometimes, but sometimes you're not gonna get the retest. That is why you need to build a relationship with whatever that you're trading, because some pairs, when they break out, they just break out and then that's just it. But you find that some other pairs, when they break out and give you the retest and then continue in the direction that they came from. Because if you look at this breakout initially, we had an inverse head and shoulder, we had this nice support, we had the pattern, and then we had a bullish engulfing candle. That's a four confirmations. Excuse me, for confirmations. You can never go wrong. These are just basic things that you need to know in the market. If you were to ask me anything, how to crack the markets, how to do well, just understand the basics. Anything else will develop as you refine and develop over time, but the basics first. So like I'm saying, that it's the direction at the end of the day that matters, because the market, if you look at it clearly, yeah, it was still trending nicely to the upside. And then these patterns are just there to tell you that we are still with this momentum, or we are still in the same boat, we are still continuing with this direction, right? Unless of course, because one of the questions that people may ask is, how do I know that we have now reached the end of a trend? Simple again. For me, I look at the type of candles. I understand that reversal patterns are there, because if you look at this clearly, how did this market or the structure reverse? You see that the market was trending to the upside, but strange enough, when it came at the top, it started forming a head and shoulder. And what is a head and shoulder? A head and shoulder is a reversal pattern. So it's this type of things that you must look out for to know whether we have reached now the end of the trend or what's going on. Then if this was a downtrending market, obviously the support we're going to look for is a head and shoulder, but an inverse one. Right. So I will end it here for flags or channels. So moving on now to, let's move on now to wedges. Let's move on now to wedges. If I can just add a little bit more in terms of patterns, because like I said, they can be found on any instrument. Because if you look carefully on USD CAD, you will see that this is an analysis that I did last week, and I did say that should the market not break this level, we're still looking for buying opportunities, because I saw this continuation pattern and it was still at the support. It's nice, it's clean, and you just need a minimum of 3 touches at least to confirm them. And then like I said, that you can either enter on the support or with the trend line in its own self, but you must also look for a breakout. And remember what I just said, that sometimes other pairs are not going to give you that retest initially, because if you look at the candle, and you must pay attention to the type of candle that breaks a trend line, right? As I was saying, guys, impulse moves and correction. Look at the type of candle that broke this market. It broke this market impulsively. And if you would recall what I said about candlesticks, you would look at the momentum that was there, and the market kept pushing to the upside. It didn't even end there. It printed another one. But now this is not a flag. It's a falling wedge, which I will get into now, right? So let's move on now to falling wedges, but I would like to start with the one that I saw on Euro NZD. Right, it's Euro NZD on the 1 hour time frame. So let's just look for a clean one. Okay, sharp. So if you look at what's going on Euro NZD at the current moment, so what is a falling wedge? A falling wedge is still a continuation pattern, but it looks like some sort of a triangle, two triangles that look like this. So this is a type of pattern that you would consider as a bullish continuation flag, right? And then this pattern, guys, form because the market, if it goes to the upside, it does not go in a straight line. These are just the type of patterns or corrections the market is taking. It's like as if you were running, then you stop for a while and then you continue. So this is what's going on. But a nice one would be, I would consider as this one. This is a nice falling wedge. So a falling wedge, what is the falling wedge? The falling wedge is the point that the market is going to the downside, but the whole idea that it's going to continue going to the upside. So a pattern or a falling wedge is a pattern that looks like this. You have your impulse, then you get your correction, and it goes to the upside. And what I like to do, I like to have a minor support or resistance. I like to have a minor support if it's there. If it's not there, it's not there. And as I keep emphasizing that you must look at the type of candles that break a trend line to continue with that direction. Because look at the candle that broke this market. It broke out impulsively and then it went to the upside. But you must be careful now when the market breaks a level or a trend line correctively, because it might not go into that intended direction. So a falling wedge would be a pattern that looks like this. It's a falling wedge because the market is taking a deep breath, and so that eventually it's going to continue to the upside. And look at what happened afterwards, right? And like I said, that is the direction that matters, because we also had a few ones here. Impulse correction, which is a falling wedge, and then it continued to the upside. So a falling wedge would be a pattern that looks like this. And then I also spotted another one because I actually took notes when I was preparing for this video. There is another one that I saw on Euro Swiss, and you would remember that on Euro Swiss I did show you this analysis that you see over here, but I'm not going to focus on it. Let's just have a clean chart so that I don't close my charts. So if you look at what's going on here, look at this small pattern. This is an example of a falling wedge. It looks like some sort of a triangle because the far ends of its trend lines kind of intersect at the end. But this would be a pure or a beautiful example of what is a falling wedge pattern looks like. And again, you look at the candle that broke out of that trend line, right? These are just basics, guys. And look at the direction. It's the direction, the pattern, and the candlestick that matters. And we even had a support level. This is why I love confluence, when you have more reasons to enter a trade, because then it builds your confidence. You don't have to worry about what could possibly be wrong. Anything can happen because the market does whatever it want to do, but it's important to focus on these type of things. Look at these ones. This is a beautiful example of falling wedge, right? And many more. So a falling wedge would be a pattern that looks like this. But then, like I said, I'm going to do bullish and bearish. So what is a bearish wedge or a rising wedge? So a rising wedge is a bearish one, which is we sell. Then if we have a falling wedge, that means overall we're looking to buy. So a rising wedge would be a pattern that looks like this. You have your impulse, and then it goes to the upside, hits a resistance, and then you get your pattern, something that looks like this, and then continue initially, at the end. And then let's check if I can find one on gold, maybe. So if we look at gold, this is also an analysis that I had. Let's see what's going on. Yeah, I didn't find a lot of falling wedges, guys, but I hope you get the sense of what I was trying to tell you. Yeah, because honestly, according to my notes, I didn't find some, and then I didn't want to waste time because I want to upload this video today. So I'm just gonna end here. But I show you that a rising wedge would be an opposite of a falling wedge. Represents sellers in the market, and it would be an opposite of a rising wedge, which is a rising wedge. A rising wedge is a representation of sellers in the market because it goes into, it's like this, and then it goes to a resistance, and then it prints that type of pattern and go to the downside. So it's something like this. Whereas a falling wedge, it's like impulse move, and then you have the correction, and then it goes to the upside. So it's the opposite of the two, bullish, bearish, right? So moving forward now to triangles, because we have bullish triangles or pennants, but I don't really find in the patterns, in the currencies that I focus on, I don't really find most of them. So, but I did make the effort to try and find some. So if we look at the cryptos, whatever you call it. So I managed to find few on in here. Sorry about this. So we're looking at the triangles now, right? Yeah. So when it comes to triangle, a triangle is what you know, impulse move, and then you have something that looks like this, and then goes to the upside. So we have bullish triangle, and then we also have a bearish triangle. So this is a pure example of what a bullish triangle would look like, which is you have your trend line support, and then you have your trend line resistance, and then but in overall the direction is to buy, or the whole point is to buy the particular market. So this would be a pure example of a bullish triangle, and we could also consider this as a bullish triangle, right? Because the market was impulsing to the upside, and then it finally took this big break, and it finally went to the upside. And if you look at the breakout was corrective because of this part, and as a result the market did, yeah, nice. Look at this type of breakout that was happening here. The market broke out here correctively, and look at what happened afterwards. Started playing around. But look at this bullish triangle. It was trending to the upside, but the breakout was impulsive, and then it went to the upside with no much of corrections afterwards. So it's such things that I'm talking about, right? And then another one that I can show you would be on USD Swiss francs, which is one of the patterns, which is one of the pairs that gives us clear and nice structures. Like I said, something about pairs that have Swiss. So if you look at this, it's an impulse move, then this was a correction, then the breakout was impulsive, but clearly there were levels that we need to take care of, which is came back, but it eventually went to the upside till, look at this, man, beautiful. impulse move. Then this is would be a pure example of what is a bullish triangle look like, because we had this impulse move and then this correction, and then we had that breakout, and then the market did what? Went to the upside. And then we even formed another one here. If you would pay attention, this is a beautiful example of a bullish triangle, right? So yeah, but I didn't also find a lot of bearish triangles, but I might come back and do a video on it. But a bearish triangle would be an opposite of this, which is we have a market, then it would trend to the upside, some in a type of triangle way, and then it goes down. So bullish triangles represents buyers in the market, then bearish triangles represent sellers in the market, right? So that is what it means. To actually show you now what is a rising wedge, I found one on GBP JPY. I think I did find one on GBP JPY in the 1 hour time frame. I did find a rising wedge on GBP JPY. Let's see. Yeah, so if you look at okay, yeah, nice. So a rising wedge, this is beautiful, will be something that looks like this. This is a beautiful example of what a rising wedge looks like, which is we have a market trending to the downside. It's the direction, guys, that matters. Like I said, it's the direction, because these patterns form in support of the overall trend or direction of the market. So if you notice, look at this impulse move, and then we also have this triangle. But it also, if you look deeper inside what's going on, you would also notice what I said, that there is no continuation pattern without a reversal pattern. Because look at this, the market went to the downside and then started going to the upside. But when it got to that resistance, even though it approached it correctively, but you would also notice that we also have a head and shoulders here. That is a representation of sellers in the market, which is a reversal pattern. So this would be a pure example of what is a rising wedge look like, right? So these are the continuation patterns that I wanted to show you today. And then there is also something that is called the 90% rule, which I think you must have heard it somewhere. So the 90% rule is based off the fact that the next impulse must cover 90% of the initial impulse, which is your 90% would be found at the very beginning of that particular pattern, which is this one. This would be the 90% rule of this pattern, and then this would be the 100% of this pattern. And then in some books you would find that they say measure the initial impulse, so that you're going to know that the length of this impulse is going to be equally in the same doors with the initial one. So that is just something that I wanted to add, but I didn't dwell much on it. But that is what is called the 90% rule. Then if I can show you again here, you see this top, one of the reasons why you would see on my analysis that I also have that is because of this 90% rule, because the initial impulse must cover 90%, the next impulse or continuation must cover 90% of the initial impulse. Then that is where I would most likely put my take profit level, because we have this impulse move, then this correction. So this impulse must cover 90% of this one. So it would probably there, that's 100%. So 90% would be somewhere along the way before there. So I'm gonna cut it here for today, guys. I hope you took something valuable from this video. And if you watched up until the end, please do me a favor to hit the subscription button. And then tomorrow I'm going to do another video, but it's going to be on reversal patterns, which is bullish and bearish. So thank you so much for watching. See you on the next video.